Hello, my name is Cindy Kilmark, and today I'd like to speak to you about a few basic accounting assumptions. So to begin, what are basic accounting assumptions, and why are they important? The U.S. government has passed laws to create a standard for accounting practices among all publicly held companies. This happened to establish credibility and to allow everyone to confidently compare different companies. It also made investing and lending to businesses safer because financials were required to be more transparent. Because of this consistency, now everyone can be confident that financial statements are accurate, reliable, and comparable across different periods of time. If a U.S. company sends a financial statement to its shareholders, for example, the assumptions have established that the report will reflect monetary amounts in U.S. currency. Let's dig into some of these assumptions a little deeper. GAAP. That's an acronym for Generally Accepted Accounting Principles. The GAAP is a common set of accepted accounting principles, standards, and procedures. All publicly traded companies in the U.S. and their accountants must follow these principles when compiling financial statements. All professionals in the accounting field are expected to know and work within the generally accepted accounting principles. Entry-level accounting professionals use basic accounting assumptions from GAAP on a daily basis when recording transactions and entries into the general ledger. Mid-level professionals use basic accounting assumptions when they're setting their goals and benchmarks. Having accurate numbers in front of them to analyze helps them to improve their performance and create new goals. By using GAAP, it helps these managers make those benchmark efforts realistic and successful. Executive-level professionals use GAAP to prepare financial reports to be dispersed to their board members, stockholders, and customers. This information is also necessary when they are looking for investors or strategically if they are looking to merge with another company. In order for both companies to have an accurate view of one another's financials, it is important that they understand that they're following the same rules. One of these assumptions contained in the generally accepted accounting principles is the economic entity assumptions. This assumption states that a business is an economic entity that stands apart as a separate organization. The activities of one business are separate and distinct from any other business. This assumption applies to all businesses, but it especially applies to sole proprietorships, whose transactional records are usually maintained by the entity's owners. In layman's terms, people using a company's financial statements to make decisions can be confident that the accounting is not tainted by the inappropriate mixing of business and personal finances. For example, John, the CEO of his drywalling company, isn't using the company credit card to fill up his personal car with gas, or using his personal checking account to pay for utilities at his company's warehouse. Each of these accounts, personal and business, are distinct and separate, so everyone can see an accurate representation of the company's finances. Another important assumption is the cost principle, also known as the historical cost principle and the historical cost concept. The cost principle requires that assets be recorded at their exact cash amount or the equivalent at the time that an asset is acquired and also for the life of that asset. Further, the amount recorded will not be increased or decreased for improvements in market value. In layman's terms, transactions should be listed on financial records at their actual cost, the original cash value at the time of purchase, rather than being recorded at perhaps their current market value. Appreciation and depreciation are used to document when an asset's price deviates from its historical cost. The cost principle also unfortunately prohibits a company from recording an asset that was not acquired in a transaction. As a result of the cost principle, some of a company's most valuable assets, for example, their brand, their intellectual property, or even management skills, will not appear as assets on the company's balance sheet because they don't have an initial purchase price to record on these financial statements. The going concern assumption. The assumption that a company or business will continue operating for the foreseeable future. This assumption allows others to believe the company will not have to liquidate, close its doors, or cease operations in the near future. Monetary unit assumption. If a transaction can be expressed in monetary terms, it should be in a company's books of accounts. Non-monetary transactions, no matter how important, cannot be entered in a company's general ledger. The monetary unit assumption is also an assumption that in the long run, the dollar is a stable unit of currency that does not lose its purchasing power. Bernie Madoff, the Enron scandal, and the Toshiba accounting scandal all illustrate that while the GAAP is required, there are always in all fields unethical people who cheat by not following the rules. So much so, as a matter of fact, that the Bible references this sort of conduct in 2 Timothy chapter 3, verse 13. While evildoers and impostors will go from bad to worse, deceiving and being deceived. Thank you so much for enjoying my presentation.